DOF Group is a provider of integrated subsea project engineering and marine services to the global offshore energy industries. Headquartered in Norway, the group occupies a highly specialized niche in the global offshore energy value chain, acting as an intermediary between asset-focused vessel owners and large oil and gas operators. The group's operations are divided into three core segments based on activities and vessel specifications: platform supply vessels, PSVs, anchor handling tug supply, AHTS vessels, and advanced subsea construction, installation, and engineering vessels. The corporate entity of DOF Group is built on a transformed structural foundation. Following a multi-year downturn in the offshore support vessel (OSV) sector, the legacy predecessor company, DOF ASA, accumulated an unsustainable debt load that led to its bankruptcy in early 2023. This debt crisis was resolved through a forced restructuring under the Norwegian Reconstruction Act, which converted approximately $572 million of outstanding debt into equity. This process diluted legacy equity holders to a nominal recovery while transferring 100% ownership of the operating assets to creditors under a newly incorporated parent entity, DOF Group ASA, which relisted on the Oslo Stock Exchange in mid-2023. Since relisting, the group has experienced a significant operational recovery, driven by rising upstream exploration and production spending and an increasingly tight global vessel supply. The group consolidated its market position through the $1.112 billion acquisition of Maersk Supply Service, MSS, in late 2024, creating one of the largest oilfield service providers listed in Oslo. The bull case: multi-year order backlog and Petrobras contracting dynamics. The primary driver of the positive investment thesis for DOF Group is its high level of contract visibility, supported by a record backlog that reduces exposure to the historical cyclicality of the marine services market. At the close of the first quarter of 2026, the group reported a firm backlog of $4.9 billion, which was subsequently boosted to $6.9 billion after the balance sheet date. This surge was driven by the award of 12-year contracts with Petrobras in Brazil. This backlog secures approximately 85% of the midpoint of the group's revised 2026 revenue guidance, while contract coverage for 2027 is already approaching 60% of projected levels. This high level of coverage supports stable cash flow generation through potential localized market corrections. This long-term backlog is anchored by deep-water operations in Brazil, where Petrobras is executing an aggressive offshore campaign to raise production at the pre-salt Búzios field. In May 2026, Petrobras awarded DOF Group Subsea Brazil a $2 billion contract for 4 newly built ROV support vessels on fixed 12-year charters starting in 2030. This award extends the group's contract visibility past 2040, with 5 core vessels committed to long-term charters. The pre-salt Deepwater Basin in Brazil is structurally protected, as operating costs are low and oil majors continue to prioritize pre-salt development. Furthermore, Petrobras has consistently extended its existing vessel charters, illustrating the strong demand for high-specification tonnage. In late 2025, Petrobras postponed the start of 7 4-year RSV contracts, including those for the Skandi Chieftain and Skandi Olympia from 2026 to 2027. To bridge this gap, Petrobras extended current active charters through the end of 2026, adding over $160 million to the backlog without causing operational downtime. Similarly, within the 50/50 joint venture with Technip FMC, DOFCON, Petrobras extended the current contracts for 3 pipelay support vessels, the Skandi Vitoria, Skandi Niteroi, and Skandi Asu, into 2027. This extension postpones the start of subsequent 3-year firm charters, locking in stable cash flows through 2029 and demonstrating that deep-water asset demand remains strong. The second structural growth driver is the ongoing transformation of the group's asset base, characterized by the successful integration of Maersk Supply Service, MSS, and a disciplined, cash-positive fleet renewal program. The acquisition of MSS in late 2024 brought a young, premium fleet with an average age of 8.5 years into the group. This integration reduced the average age of DOF's combined subsea and AHTS fleet from 11.7 years to 10.7 years. The transaction has delivered immediate financial performance. The acquired fleet, reported as DOF Denmark, generated full-year 2025 EBITDA of $181 million, fully validating the strategic acquisition rationale. To capitalize on the tight global supply-demand balance for high-specification offshore vessels, management is executing a selective asset arbitrage program. During 2025 and early 2026, the group systematically divested lower specification and legacy assets, including the 2002-built AHTS Scandi Handler, the 2016-built cable layer Scandi Connector, agreed for sale in Q3 2026 to focus strictly on integrated subsea services, and several older AHTS units, such as the Scandi Tender and Scandi Trader. Simultaneously, the group acquired two ultra-high-end AHTS vessels, the Aurora Saltfjord, renamed Scandi Saltfjord, and the Aurora Sandefjord, built in 2011 and boasting massive 390-ton bullard pool capacities, alongside work-class ROVs and subsea cranes. In tandem with its conventional oil and gas activities, the group is expanding into offshore wind and power transmission. This transition was accelerated by the carve-out of MSS's offshore wind turbine installation business, now Maersk Offshore Wind, leaving the group to focus on overlapping services like mooring, towing, hookup, and cable laying. Operational milestones include the opening of a dedicated regional hub in Busan, Korea, to target the region's planned 4 gigawatt of floating wind by 2030. The group also secured a substantial contract from Norway's Statnett for the Ofotfjorden high-voltage power cable replacement project, to be executed in 2027 using a high-capacity construction vessel over 40 days. This transition to renewables leverages the group's subsea engineering expertise, protecting the business from potential shifts in conventional offshore spending. The group's growing financial flexibility supports a positive investment thesis, representing a significant shift from its debt-heavy pre-restructuring period. Operational cash flow generation has been exceptionally strong, reaching $249 million in Q4 2025 under management reporting. This cash generation has allowed the company to maintain a conservative leverage profile, with its net interest-bearing debt (NIBD) to LTM EBITDA ratio hovering between 1.7x and 1.9x, comfortably within the group's target range of 1.5x to 2.0x. A key financial catalyst occurred in early 2026 when the group secured necessary credit approvals from lenders to significantly alter the amortization profile of its senior secured term loan facility. Under the agreed amendment, the mandatory annual amortization payments were reduced by 40%, dropping from $144 million to $86 million annually, provided the group's leverage ratio remains below 2.0x NIBD/NTM EBITDA. This structural reduction in mandatory debt service lowers the company's cash flow break-even point and frees up an incremental $58 million in annual liquidity. These freed cash flows have been immediately directed toward accelerating shareholder returns, supported by structurally lower mandatory debt amortization. Following the initiation of dividend payments in 2025, the board has raised the quarterly distribution sequentially, declaring a dividend of $0.35 per share for Q4 2025, which was subsequently raised by 5.7% to $0.37 per share for Q1 2026. The cash payout ratio currently tracks close to 50% of normalized earnings, establishing a clear pathway for sustained dividend yields. The bear case: yard construction and financial execution risk of RSV new builds. The primary risk within the negative investment thesis centers on the massive capital expenditure and shipyard execution risks associated with the $2 billion Petrobras RSV contract awarded in May 2026. Unlike traditional service contracts utilizing existing assets, this contract requires the construction of 4 brand-new high-specification ROV support vessels. These vessels are designed as large DP2 platforms, 98 meters length by 20 meters beam, equipped with subsea cranes, accommodation for 58 personnel, and dual work-class ROVs. Critically, they are designed as highly complex hybrid propulsion green vessels capable of running on ethanol and diesel. To satisfy Petrobras's strict local content and import regulations, the group expects to build these vessels at the NAV shipyard in Brazil, with the first 2 units scheduled for delivery within 4 years of contract signature. Shipyard execution in Brazil has historically been plagued by severe operational bottlenecks, labor shortages, and cost overruns. Constructing technologically complex hybrid vessels in a region known for shipyard delays introduces substantial risk of late delivery penalties and cost escalations from Petrobras, which could erode the projected margins of the $2 billion contract. Furthermore, the funding mechanism for this multi-vessel new build program introduces strategic uncertainty.
While management intends to secure local development debt from Brazil's Fund for Merchant Marine at attractive terms, the total capital expenditure required to construct 4 advanced subsea vessels will be highly capital-intensive, potentially draining cash flows during the 2026-2029 construction phase, before any revenue is realized in 2030. Management's disclosure that they are considering alternative ownership structures for these vessels highlights a potential need to utilize joint ventures, sale-leaseback structures, or minority equity partners. While these strategies limit direct balance sheet leverage, they also risk diluting the long-term economics of the contract, shifting asset ownership away from the group and adding structural complexity. Despite the strong macroeconomic narrative, the group's financial performance remains highly sensitive to localized operational disruptions, scheduled vessel dry dockings, and contract mobilization costs, which can introduce significant quarter-to-quarter margin volatility. This operational vulnerability was clearly visible in the Q1 2026 results, where average fleet utilization fell to 82%, down from 87% in Q4 2025. While Q1 revenue rose 11% year-over-year to $175 million under management reporting, the company's stock fell by 5.84% immediately following the earnings release. This market reaction highlights investor sensitivity to rising operational costs and earnings volatility.
The drop in profitability during the first quarter of 2026 was largely driven by a heavy volume of scheduled vessel maintenance and contract preparation. Operating expenses rose significantly to $326 million in Q1 2026 under financial reporting from $267 million in the prior year period. This rise was driven by non-recurring contract mobilization costs, dry docking expenditures, and unexpected downtime. For instance, the unscheduled withdrawal of the Scandi Minder from active service during the quarter directly restricted the company's ability to capture high spot market day rates, demonstrating that even minor technical failures in a tight vessel market can lead to immediate revenue losses and elevated repair costs. Furthermore, the cash flow statement reveals the capital-intensive nature of maintaining a highly utilized subsea fleet. In Q1 2026, the group experienced a substantial working capital buildup of $89 million, alongside $19 million in additional contract mobilization costs. These cash outflows, combined with interest and tax payments, reduced net cash from operating activities to just $46 million, down from $70 million in Q1 2025. This operational cash flow contraction highlights a clear reality. During periods of intense fleet mobilization and dry docking, the actual free cash flow generated by the business can decline significantly, exposing the group to liquidity pressure if multiple vessels undergo simultaneous maintenance. The third bear case argument focuses on the broader market cycle, suggesting that the offshore services industry may be approaching its cyclical peak, leaving limited room for further valuation multiple expansion. While current demand remains robust, consensus analyst forecasts suggest a potential structural transition in the group's financial trajectory. Specifically, market consensus projects that the group's earnings could compress by approximately 2.1% per year over the next 3 years, even as revenues are expected to grow at a modest 3.9% annually. This projected divergence points to structural headwinds, including 1. Operating cost inflation, high wage inflation for specialized marine crews and subsea engineers, alongside rising costs for marine equipment and docking services. 2. Day rate plateaus, a leveling off of spot and short-term day rates as oil majors exercise capital discipline in response to projected global crude surpluses of over 2 million barrels per day in 2026. 3. EBITDA margin normalization, a gradual contraction of the group's historically high EBITDA margins, which stood at 35% under management reporting in Q1 2026, as older, highly profitable contracts roll over into more competitive bidding environments. Additionally, the sustainability of the group's high capital return program is a point of concern. At a current share price of approximately 115 Norwegian kroners, the annualized dividend yield of over 10% is one of the highest in the offshore sector. However, bears argue that this payout ratio is not fully covered by organic free cash flow when accounting for ongoing maintenance capex and fleet high-grading requirements. With Q4 2025 purchase of tangible assets, CapEx, reaching $106 million, and Q1 2026 operating cash flow falling to $46 million under financial reporting, maintaining a quarterly dividend payout of $0.37 per share, equivalent to approximately $91 million quarterly across 246 million outstanding shares, may eventually require drawing down cash reserves or increasing debt. If the offshore market experiences a sharper than expected cyclical correction, this high dividend payout could quickly become unsustainable. Conclusion: synthesizing the bull and bear cases reveals that DOF Group presents an asymmetric investment profile, where structurally locked-in revenues confront near-term operational execution and shipyard challenges. While shipyard risks in Brazil and scheduled dry docking downtime present short-term headwinds, the group's multi-year order backlog provides a buffer against broader market corrections. While operational downtime and construction risks in Brazil are valid concerns, the risk-reward skew remains favorable. The combination of $6.9 billion backlog, a 10% annualized dividend yield, and structurally rising deep-water subsea infrastructure requirements provides a compelling margin of safety.